It should be the regulatory panel on technical structuring, but we're going to be talking about security tokens, which is on everybody's mind. It has been on everybody's mind for about a year and a half already. Talking about potentially this is the next big wave of money coming into the industry, or it's an innovative way, or it's the answer to the craziness that was ICOs. Let's give a chance for all the panelists to introduce themselves, starting with you, Chris.
Who was here yesterday for the security token panel? So a handful of people. We talked then about sort of the legal framework behind it. Now I think we're going to talk more about the technical process of setting up those security tokens. So quick background on me, Chris Housser, co-founder of Polymath. I'm a lawyer by background. I've been in the blockchain space for a number of years, and we're building a platform to make it easier for people to create security tokens.
My name is Juan Hernandez. I'm the founder and CEO of Open Finance Network. We're the first regulated security token trading platform in the United States. So we are live, we're active, we're trading tokens such as blockchain capital and others. And we'll talk a bit more about what it takes to be eligible to be listed on a security token trading platform like ours.
Good afternoon. Ron Poe with Securrency. We do compliant security token offerings, and we've been working on this since 2015. We've always said these are going to be securities. That's why our name is Securrency. It's securities and currency together, and interested to see how the market continues to evolve from this point forward.
Yeah, I think it will be interesting to see how the market evolves from this point forward. It is what I'm seeing is the first thing is people are building the exchanges first. Is there any reason for that? Why are we seeing exchanges being built first? Like security token exchanges are the first thing that everybody's building. It seems like on the panel are 3 different security exchanges.
I wouldn't say the exchanges are the first ones being built. I think folks like Polymath and Securrency and others have been out there for some time trying to work with the issuers on doing their compliant security tokens. I think certainly the exchanges didn't have to come after that. I think that's been the logical order.
One of the things that investors really want is liquidity, so that's what the exchanges are there to help provide liquidity for these tokens. But as Juan was saying, before getting on exchange, these tokens need to be created, and that's what we're working on. Polymath, we're building a framework and a standard for people to create security tokens in a way that the exchanges are able to operate with, and the regulators, the investors, the issuers, the exchanges, all the players in the space are able to understand this standard and what features it has that makes these tokens transfer restricted and different than standard Ethereum tokens that you can transfer to any address.
Let's start defining things. A security token is what?
A security.
It's that simple. It's not a version of a token that represents shares or a token that represents voting rights or something else. It's a mixture of all 3 that would be a traditional security listed on a stock exchange.
It could be listed on a stock exchange. I think the main security tokens that are being created at first aren't necessarily the publicly traded securities, not the shares that you'd find on the New York Stock Exchange. They're more the private companies. So if you have a private company now, if you tokenize, it makes liquidity easier than in the traditional market, where liquidity is hard to find for a lot of these private offerings.
Can you give me some examples of security tokens that exist?
The blockchain capital. One of the, I believe the first, the first security token that hit the market. They're a venture capital fund out of San Francisco. Mm-hmm. They have several funds, I believe, and one of their funds they did as a security token offering.
But with BCAP, I think they raised $10 million about 2 years ago. And at first they issued ERC20 tokens, and then people were able to freely trade these Ethereum tokens between any addresses. I think they quickly realized that was problematic from a regulatory standpoint. So they've now converted that original token into a more compliant standard. So now you can't just transfer it to any address, and it's now trading on Open Finance as well.
So one of the things I know that Securrency is working on is potentially an easier and more auditable way for people to send security tokens from one person to another. Uh-huh. What does that look like?
Basically like an atomic swap that you're talking about,
mm-hmm.
Which I'm not going to go into probably an explanation of, but basically it's an irreversible transaction, more or less, is what you're trying to, we don't want people to be able to reverse a transaction. The way that, like, if you get a wire transfer, you can't reverse it. If it's an ACH, you can, right? And if you ever had an ACH reversed, it's kind of a surprising thing that you don't like where'd the money go? And so in the same sort of way, once an exchange is made, you want to have some finality in the transaction.
So a lot of the problems, people were talking about security tokens and making a security token and potentially as a mechanism for raising money for their company that isn't a utility token where it's used in an ecosystem, but rather I want to raise $10 million to open up a new franchise of McDonald's. What would that look like if I needed it to be regulated? Could you walk me through the steps, Chris, on the Polymath platform?
Sure. So really there's two hurdles I think you need to overcome if you're going to issue a tokenized asset. There's the technical hurdle and there's the legal hurdle. And at Polymath, what we help people through is the technical process. Right now, if you want to create a token on Ethereum, coding's very difficult. A number of projects have been hacked. So what we've done is we've created a standard that's very easy for people to point and click. I think a number of you have probably been by our booth. And you can create this token in a matter of minutes that has restrictions built in that you so choose. And you can work with lawyers to help you figure out what those restrictions might be. But the technical part of it on Polymath is easy. Then you got to link up with third-party providers through KYC, AML, legal to get your documents all sorted out. But really, for us, it's solving that technical problem.
So
and that's what we look for as well when we look at tokens, security tokens that we that apply to us to get listed. We look to see if they've used some sort of standardized framework, like a Polymath framework, or like Securrency's mechanisms, or some other providers out there, because we don't want people rolling their own technical framework, because that's fraught with a lot of risk and error. And for us, we want to make sure that we've been able to test and integrate with these different technical frameworks in a way that allows us then to scale up quickly.
Okay, so I'm going to make a new franchise of McDonald's. I want to raise $10 million. I'm going to go to Polymath or Securrency or something. And instead of figuring out how to create the token myself, I'm going to use one of your guys' services, tokenize that $10 million, and then sell those tokens as securities to people to raise funds. Or am I going to go to an exchange with those tokens and look for liquidity there?
And typically, you start with the primary offering, which is sort of that initial capital raise, and then you work with folks like Polymath or Securrency to assist you with that process. And then you come to a regulated trading platform like ours to then list your security once it's already completed.
And the difference is really how to compress those, the time, because you're not locked up for such a long period of time. If anyone's invested in a private placement, it all depends on what they define as how long you have to hold on to that. I mean, that's a fundamental difference, where you're bringing basically public market liquidity trading capability into private markets, which are, people say are awash with cash, and a lot of the profit's been sucked out of the public markets. And so if you can bring those technology capabilities into those private markets, then that's how you unlock the $10 million for the McDonald's franchise or whatever. I don't know if I've seen a use case for the McDonald's franchise, but if there's something else. But there's lots of companies could benefit if they could raise money. It's not easy to do, and if you're not raising a certain level of money, the broker dealers don't want to talk to you. It's not worth their time, right? They're going to get a certain percentage in this and that, but they get a percentage of a bigger number for essentially maybe doing about the same amount of work.
I said this yesterday too. If you're looking to raise $10 million for your Moe Donald's project, if you can't raise that $10 million in the traditional sense, I don't think you're going to be able to raise that money just because you do an STO. You really have to have a business that's attractive to people, that people want to invest in. And it's the security token mechanisms that give additional benefits on top of that, like automate dividend payments, earlier exits. Now you can get out faster than waiting 10 years to get out of a venture fund, proxy voting. So there's a lot of cool features that can be put in these tokens to make them more attractive, but that doesn't mean people are just going to invest in projects that are otherwise crap.
And the price should be different too. If I can sell it soon rather than 10 years, then I'll pay more. Yeah, it's a liquidity premium,
you're unlocking
right?
that liquidity premium in these historically illiquid assets.
Yeah, the easiest way I've heard to understand that is, imagine if you bought a car and you had to keep it for 10 years.
Yeah.
I mean, what would you be willing to pay for it? How much more due diligence would you do on that car before you bought it? I mean, it would be long and dragged out, as opposed to walking in a dealer and pointing at one and say, I'll take that one, right? So that's what it's like in private placements. But if I could sell it, if I decide I don't like it 6 months later, you'd pay more. It wouldn't take as long to make a decision. All those same things, I think, transfer into private placement markets.
So now that we have these security, let's talk about a little bit about the state of security tokens right now, because it seems like one of the hurdles is the liquidity pools to purchase these tokens and token exchanges being active live and having offerings for people to invest in. Is this a chicken and egg sort of situation where we're just waiting for more things to come, or what are you seeing?
Yeah, I mean, for us, we're seeing a lot of high quality projects that are in process right now that are doing their initial primary offering. And so when they complete their offering, then they're eligible to list on the platform. So the pipeline, I think, of security tokens we're seeing from some of our partners, Polymath for Securrency, very deep, and they'll start to emerge more marquee name offerings. I think some of these security tokens that are out there today are not very well known. They're not household names, if you will. Sure. But we're starting to see more and more bigger players start to dip their toes into this market.
I think we're definitely still in the growth phase.
Yeah.
People are not quite ready to embrace security tokens. They're really scared of what if they lose their private keys. Institutions aren't necessarily on board. So there's a lot of education that we need to do just with the whole community to get people to understand and be more comfortable with tokenizing assets and how they can trade them, what the benefits are. And everyone's sort of scared to be that first mover. There are a few projects out there already, but the people that we talk to, they keep asking, show us an example of someone who's done it before. Okay, show us another example. And they just want to see repeated people using this project. And until people are brave and just take that first leap forward, I think we're going to have to keep educating and getting people comfortable.
Yeah, there's an old saying in ground combat, the guy at the point is the one most likely to get shot, right? So Chris and I talking about this earlier in terms of shared experience. So nobody wants to be that guy necessarily, right? But someone's got to charge the fort. But this goes back to, I mean, we're basically talking about securities law since 1933, right? I mean, I think we all need to kind of catch our breath and be patient a little bit too, is we're really talking about the same laws since then, since 1933, and all this innovation, the technologies and the tools and everything that's available that everyone's developing has really only been available for the last few years. It's, you know, I mean, this is like the Apple Newton that was out a little too early, right? It's the same kind of concept as an iPhone, and so it's coming. It's going to happen. I haven't talked to anyone who, everyone says categorically it's going to happen. Everything's going to tokenize. The only question is when and how. That's really it. And nope, I haven't heard anyone say it's no way, it'll never happen.
In terms of the regulation, yes, some of the original laws were written back in the 30s, but actually there was a refresh of these laws back in 2012 as part of the Jobs Act that President Obama passed. Missed that guy. So in 2012, they passed this refresh to a certain extent to some of these securities laws, and they allowed things like general solicitation. So what that means effectively is prior to this change, you could not stand up here on stage and just announce to the general public that you were doing some sort of capital raise for your company or your fund. After the Jobs Act passing, then you had that mechanism to be able to do general solicitation. I mean, there's still parameters around. You can't just blast out from the rooftops, but it opened up this capital market. It provided access to these capital markets for millions of small companies around the nation. But at the time, the technology around that mechanism wasn't really there. It eased some of the access, but it didn't really reduce any of the friction. And now with the blockchain distributed ledger technology, it's reduced a lot of the friction. It makes it easier to effectively manage a capital raise where you might have thousands, maybe millions of investors, right? In the old model, you'd have to somehow figure out a way to get their distributions to them, and everyone would have to update their bank account on your online platform, and that's just a nightmare. But as we've touched on, for example, with automated distributions, you can do that now because you have access to people's wallets and you can deposit straight distributions, either in Ethereum or some sort of stablecoin mechanism. So the technology has now reduced a lot of the friction and opened up these capital markets to a broader set of users.
It's a great explanation, actually, as well. Well done.
So I think, Chris, coming back to what you said before, that I think there is a misconception that people have that security tokens are an alternative to ICOs in that it's quick money fast. That's not the case at all. And there's the issue that it's hard to be the first mover in the security token arena. Do you think we're going to be seeing a lot more security tokens come domestically because there's better regulation, or will there be security tokens coming around from all over the world, smaller projects that people can invest in because the pool of investors is not domestic, the pool of investors with security tokens? One of the additional benefits is anybody can invest in them and own it, provided that they pass whatever local and international laws they need to pass.
I think both. Despite what people say, I think the securities laws here in the U.S. are pretty crystal clear. So it's evident kind of the steps you need to take to remain compliant and do your offering here. In other countries, it's still being formed. Certain jurisdictions like Singapore or the EU are starting to define their rule set a little bit better. But here in the United States, perhaps you may feel that they're too restrictive, but they're clear to a certain extent. And so a lot of the stuff that we see in the pipeline is taking advantage of U.S. regulations. They may not be domiciled in the U.S. There are a lot of overseas companies that we see, but they're taking advantage of U.S. regulations and laws. So they're using the Regulation D and Regulation S pairing, for example. It's a very popular one. And those are based off U.S. securities law.
And what we're doing in our ERC 1400 standard is we're putting a lot of these regulations into the code itself. So the code's able to make sure that the regulations are not broken. For example, for Reg D offerings, there's a 1-year hold period. So baked into the code itself, it will prohibit anyone from transferring that token before 1 year is up. If there's over 2,000 investors in a private placement, now you're deemed a public company. So the code can prohibit there from being more than 2,000 holders of that token. And we're constantly adding new features to comply with not only US regulations, but regulations in other countries as well, to make it easier for people to comply with the rules and regulations in their jurisdictions, and the code will automate that all for them. So it's a long process, especially with different rules across many countries, but so many countries are interested in security tokens. And Thailand, the stock exchange there just applied for a cryptocurrency license. We at Polymath have a share in the Barbados Stock Exchange, and there's lots of other exchanges as well that are moving towards the crypto world as well in every country.
And technology is global, of course. I mean, people can access anything from anywhere, but the laws are local, right? And it's going to end up where that consumer is really what's going to govern the law of that investor who's buying that. And then where the technology rolls into that is whoever buys it first, and then if they trade it to somebody who's in a different jurisdiction, then that jurisdiction is going to have an interest in it. And this kind of, sometimes people say, well, we won't sell it to Americans, but then the non-Americans sell it to Americans. Well, SEC is going to care then, right? So, I mean, that's kind of juvenile to think that they're not going to, as soon as it ends up in the hand of Americans, they're going to want to know because they're going to want to tax it sooner or later anyway. Sure. But that's where the local and the global kind of cross over with each other. And it's complicated because then if you want to sell to anyone in any country, then you have to cover every jurisdiction in the world.
And this is where some of the technical structuring will come in, where wallets will or will not be able to accept certain tokens from certain countries that were generated in certain jurisdictions. Out of curiosity, generally speaking with tech companies, somebody will raise a seed round, a Series A, Series B. Is this something that would move to a security token in the future? Is this something we could see replicated in a security token environment?
I think so, yeah. I mean,
yeah. Certainly. I mean, to us, that's really what we're starting to focus on as well, is helping early stage companies tokenize. And now they can get funding at one stage. Now they want to go to seed B round, let them do a second round. And we're really building this framework where we can work with young entrepreneurs to tokenize right from the start, and then they can go through many different funding rounds if they need more money at any given time.
Yeah, why not? It's moving towards mainstream. So whatever the functions are that are happening in mainstream financial services, then these technologies are moving in that direction, and those will be. It's a matter, there's the early stage, the same person I said, the early stage person who might get shot, as you figure out exactly how that's going to be. Does the SEC give guidance, or what? Are you trying to read into what they don't say, or whatever the case is? But it's happening. It goes back to the same thing. It's how and when that I mentioned before. It's going to happen sooner or later, and it's just another offering. It's no reason why it shouldn't be tokenized.
And that's the right sort of intent of what these regulations are trying to facilitate is access to these capital markets for small companies, for small or medium-sized companies who want to tap into these capital markets to help grow their business. And I think the model you just described of actually doing tranches of, okay, let's do a small round, deliver product, validate, the concept, and then do a larger round, and that's the right approach versus what we saw in years past, where certain projects just raise mega rounds without having delivered a line of code, and then you see how a lot of those turned out.
And there's definitely more risk in the early rounds because the company hasn't built anything out really. It's just a proof of concept, and they're raising some money. So the more risk, you'd think those people in the earlier rounds will get a greater reward than the people who come in at a later stage when the company is more fleshed out. And I think it's just really, it's already happening in the traditional world. Why not happen in the security token world as well?
There were talks about in a future where security tokens are part of normal financing, that potentially because of the restrictions, companies that were listed on other exchanges would delist and then move to security tokens exchanges. Do you have any comments on that or thoughts that might happen?
I think a lot of, we've touched on some of the different regulations across different jurisdictions. That's really, if you have what we're calling, dumb securities, that don't have that ability to kind of adapt and adhere to different rule sets, it becomes very difficult to do that. But with these security tokens that are effectively smart contracts, the regulations written into the smart contract, you can account for all those different restrictions and different jurisdictional preferences, right? The EU prefers things one way versus the United States, and so if you're transacting securities across both those jurisdictions, there's different rules you have to adhere to on each side, and the security tokens and the smart contracts that are wrapped around them allow for that flexibility. So I do think it will become a preferred method because it just simply provides more freedom and flexibility to the issuer. Do you see it as a preferred method, or do you think that companies like the New York Stock Exchange would convert their listed equities as into versions of security tokens with additional features? I think that's got a long ways to go. Yeah. I think right now we talk a lot about the security tokens are basically private companies, private securities. When you think about NASDAQ and NYSE, just public equities, and there's a lot of other additional counterparties that take part in all those transactions. You have central counterparty clearing houses, you have central securities depositories. Notice how they both have central in their name. You've got different custodians, banks, and brokers that are involved, and I think there's still a lot of clarity that needs to be provided as to which one of those pieces can be removed, for example. So, if you have things on chain, if you're using a distributed ledger mechanism, do you really need an entity to provide counterparty risk protection? Or if that's already baked in, then can that entity be effectively relegated to the sidelines? But there's a long path ahead for that.
I think in a utopian future, all securities, all shares will be in tokenized form. It's a long way to go. I fully agree with that. But right now, it's companies like ours and Open Finance, Securrency, and many others that are building the infrastructure needed to get to that utopian future.
Yeah, and I think it's the saying that we always overestimate what we can do in 2 years and underestimate in 10. So Bill Gates maybe said that, I think, something. So it's the same thing. It's in 10 years, the securities markets could be fundamentally different. I mean, and to kind of answer and avoid answering your question, we're still talking about private markets right now, but we're talking about bringing in public. I can't imagine someone delisting for the purpose of doing a security token, but I guess there could be a reason for it. But it's bringing that public market liquidity, technology, capability, all those things into private markets. That's really where we're starting right now, but where would be, and that's probably the 2-year problem, but the 10-year, I don't know, I can't even conjecture where 10 years would be in this market.
Stuff definitely takes longer than you anticipated. I know in 2017, I was saying 2018 would be the year of STOs and security tokens. There's traction coming, but I don't think there's that many security tokens out there, definitely not from 2018. Is 2019 going to be the year? Maybe, maybe not. 2020, maybe. But I think at some point we're going to reach that tipping point where all of a sudden it's going to go way faster than we expected.
That's it, the tipping point, exactly. And then I think it'll just turn.
And the tipping point is going to be when institutional participants start coming in and leveraging these mechanisms. And I think what's going to drive them to that adoption is the least sexy thing of all. It's operational efficiency, because that's what the distributed ledger mechanism provides. It allows you to more easily manage your books and records, your cap table. It allows you to more easily facilitate transfers of ownership within your shareholders. It allows you to more easily do distributions. And so that operational efficiency and a cost reduction, that's going to be the main driver, not the sexy hype and buzziness of blockchain.
On that note, let's please thank our panelists as they get off the stage.
Thank you, Mo.
Thanks.